The new Wall Street Week.
Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
And I'm Maria Bartiromo. Anthony Scaramucci will be back next week. A few weeks ago, we were at the Skybridge Alternative Investing Conference in Las Vegas. Quite a conference at an event so full of legendary investors. It struck me how the vast majority of people we spoke with were pessimistic about the U.S. market, at least in the near-term future.
Why is that? And do our guests today hold the same view? We welcome Charles Schwab, Chief Investment Strategist, Liz Ann Sonders, and Mark Asset Management founder Morris Mark. And we were all actually out at the SALT conference. And Morris, let's start right with you in terms of the markets today. You don't see things as negative as some of the other participants at that conference did, do you?
No, I think it's a fairly valued market. We have a growing economy, but it's not accelerating. So I think there's great opportunity for really terrific businesses to build value. And there's a lot of problems for businesses that are going to be taken advantage of by those great businesses.
Well, you have invested, you're the envy of many investors because many of the stocks that worked last year, we're talking about Facebook and Google and Amazon. You're a value investor, but you owned a lot of these stocks and you continue to own them. What's the thesis besides them working? Why do you own them?
Yeah, we don't own, of course, we want them to work, but I think we really want to own great businesses. We're very cognizant of value, but to us, value is the present value of future cash flow properly discounted. You don't want to pay too much for that, but none of these companies, not even Amazon, if you look at it in terms of its free cash flow multiple, are expensive. And conversely, they're really super businesses. If I were to look at Google and Facebook, for example, and they are important investments, to me, they're the two most important media companies in the world. There are a lot of other great media businesses, including Fox, but both of these companies essentially operate throughout the entire world, excluding China. So they can leverage their asset base, their database, their software, their skills, and in fact benefit from the fact that they control networks that are worldwide.
So you're doing what any great investor would do, and that is looking for growth in a low-growth world. So, Liz Ann, let me turn that to you. Where do you see the growth today, and would that be a place, not necessarily specific stocks, but spaces, industries, would that be a place to actually put money to work in?
Yeah, I do think you want to have a cyclical bias in portfolios right now. I think the pickup in the economy that we anticipate is going to come. Financials, I think, are interesting. I think take the Fed at their word that they are going to continue to inch up interest rates. So we've had an outperform rating on financials for a while. Got a little bit painful there for a short period, but I think that makes sense. And technology, actually, I think is one of the prime areas where you can find growth at a reasonable price.
Which
so those
is
are the
Morris.
Right. Yeah. So those are the two sectors we have favorable ratings on.
You know, Morris, we're going to talk later in the program about the tech bubble of '99. And when I think about those stocks that we talked about that are working right now and continue to work, how do you know when to exit a stock like that? What's the sell signal where the growth is no longer paramount and you have to worry about the right price?
Well, there are a lot of reasons. I think of two stocks like this that we sold in the last year. LinkedIn, when a lot of the businesses that they acquired did not contribute to the company's growth, and it was a very, very generously valued stock. So when you see that, don't pass go, don't collect $200, leave. Another one that we sold also was Yahoo, because we did a lot of work on the legal risk related to the proposed spin-off with Alibaba, and we did a lot of work on Alibaba, and we weren't comfortable with the legal risk, and we got a lot less comfortable with Alibaba. So it's looking at the business. If the numbers don't work, you leave.
Yeah. So you're looking at valuation as well as the growth prospects. In terms of valuation, why aren't some of those other names like the Facebook, the Googles, the ones that you've owned and sort of ridden as they've moved up, why aren't you having issues about valuations there?
We have issues every day. That's why we go to work every day, and we love it. It's a great opportunity.
But you don't see the same situation there that you do in like a LinkedIn.
Absolutely not. I mean, if you look at Facebook, one, you have a very entrepreneurial CEO who owns a lot of stocks, so he's your partner, seems to be dedicated to building the respective businesses that it owns. And if you look at it, it has literally billions of users. As of the last quarterly report, they said that about 1 billion of them spend 50 minutes a day on the respective networks. I think there were TV networks that would kill for that audience.
For sure.
Lizanne, let's talk about active management. Morris, obviously an active manager versus indexing. One of the things I heard all over the holiday weekend, again, and you hear it daily, is why even give any money to an active manager 8 years later? Indexing continues to really work. What do you tell the Schwab clients when they face that question to you?
Well, I think we are seeing a shrinkage in the active management space, and I think that that's a long-term secular trend. The key, obviously, is which active manager are you going to hire?
Well, that is the key, yes.
So, and I think we're probably overstored in a lot of that space, but I think there is still a tremendous amount of talent. It may be a smaller number than existed before, and I think for a lot of investors, taking a passive approach probably does make sense, as opposed to either trying to do it on their own or trying to find some of those high-quality managers. Fundamentally, though, I actually think with correlations coming down, broadly from a macro perspective, and the opportunity for active over passive is here right now.
All right, stay there. Lizanne Morris will be right back with more.